Hi, I'm Jay Richards. We're here at the COSM 2021 conference in Bellevue, Washington, and I'm joined by a longtime friend, Bryan Mistele, who is the CEO of Inrix, which is headquartered here on the east side near Seattle. Bryan, good to see you.
Great. Thanks for having me, Rick.
Yeah, so we you just finished up a panel, and it was actually on a subject that for a lot of people I think was fresh. In fact, it was fresh for me. And so a lot of the stuff we've been talking about has had to do with the technology side, and this was about the finance side. So the topic of the panel is called SPACs, IPOs, and direct listings, new tools to unlock capital markets. I'm guessing most people know what IPOs are, initial public offerings, but what the heck are SPACs?
Well, it's interesting because a year ago they didn't really exist in any real quantities, and it's completely transformed the market. In fact, the majority of companies today going public do through SPACs.
Okay.
So a SPAC stands for Special Purpose Acquisition Corporation. What it is it's a group of people who get together, usually 2 or 3 people.
Yep.
They raise some money, and then they go public with a shell holding company. It's called a blank check company. There's nothing in the company but cash. And then they go looking for a company to acquire. So they acquire an existing business, and then it's a reverse merger. So long story short, a SPAC is nothing but a backdoor IPO where cash acquires a company, as opposed to an IPO where the company goes out and gets cash. But the result is the same, a public company that's an operating company that's in the public markets.
Okay, so is there some advantage to this over an IPO?
Yeah, there's really a couple of advantages. One is, first of all, the way that the SPACs get priced. The company basically negotiates the price up front with the SPAC, as opposed to an IPO where you don't know the value of your company until the day it goes public or the night before it goes public, because they're trying to build a book of supply and demand. So one of the big benefits is the price. You know up front what the value of the company is worth. And then the other is there's some structural benefits, because in a SPAC you can give a forward-looking story, a forward-looking forecast, whereas in an IPO you can't. An IPO, you can only provide historical financials. You can't give any forward-looking statements. So for a company that's either growing rapidly or investing in new products, and they want to talk about what the next couple of years will look like, the SPAC is the better route. So
it seems obscure, though. And in fact, during your panel, there was the analogy that someone proposed was this is sort of like a courtship and an engagement and a dowry, and you've got the dowry, but you don't actually know who you're going to get to marry till right at the end. And so for investors, I mean, why would they want to do it this way?
Well, I think there's 2 benefits. One is, again, this is a couple of folks, usually CEOs of publicly traded companies or retired CEOs that create these SPACs.
Right.
So the benefit, I think, to the public markets is it is like speed dating, where you have hundreds of SPACs looking at hundreds of companies. There's a lot of conversations trying to find the right fit. It is like musical chairs. But at the end of the day, you've got a smart person, a CEO or an operator or a hedge fund manager, basically running these things, who then get to decide which is the best company for us to work with. So there's a lot of due diligence. There's a lot of discussion. There's a lot of conversation about the business plan. Whereas in a traditional IPO, if you can basically go public and the investors have very little opportunity, usually maybe a half an hour or a phone call to basically understand what the company's doing or what the story is. So there are some real benefits to the markets in terms of due diligence, really understanding the companies before they go public.
Well, and so a few years ago, I know, in fact, at a COSM conference, I think even 2 years ago, we were talking about the diminishing number of IPOs, if you compare it to, I don't know, the heyday, the late 1990s or something. Is that still true, or is this changing, or is SPACs going to kind of change the landscape? What's your sense of that?
Oh, this has significantly changed the landscape.
Okay.
And it's because of Sarbanes-Oxley in 2002, it got a lot harder for companies to go public. So they started waiting a lot longer in terms of actually being able to get to the markets, because they could raise a lot of money in the private markets and then go public at 10, 20, $30 billion. This is changing that, because it's allowing public market investors to get invested earlier into these companies. And as a result, a lot of companies now are going through these processes. So just the number, if you look at the graph, the number of IPOs just in the last year has dwarfed the previous couple years because of this phenomenon.
Okay, and so you mentioned this problem, and I don't know if this applies to Inrix or not, but it sounded almost personal, that I think you told it's sort of a tweens problem. It's like a company that's been going for a while, still not huge, but can fall into this kind of valley that's a sort of problem with respect to funding after you suddenly post a profit. Describe that.
Yeah, sure. So the tweener problem, as I call it, is basically this disconnect in the market in terms of how companies get valued. in the early days when you start a company, I remember going around and pitching all these venture capital firms.
Yeah.
You're basically valued on the dream, right? How big could the company be? What's the dream? And then basically, if you can find an investor to give you cash at a valuation, that's really up to you and how well you sold your pitch.
Yeah.
Right? The problem is, as that company grows, at some point it turns profitable. And now all of a sudden the investors, the late stage private equity firms in the markets, they value the company based on multiples of earnings or multiples of revenue. So you have this disconnect and this tweener problem where it's easy to raise cash off of a dream. And then as soon as the company becomes profitable, it gets really, really hard because you don't have enough profits where any realistic multiple would make it worth more than what it was the day before. So, the SPAC kind of helps solve that problem by bringing public market capital into this stage where companies can really talk to the operators and the heads of the SPAC and the sponsors and basically have an explanation about what's going on, and they can kind of look at the history and make an intelligent decision about what that company's valued. So it does solve this tweener problem where it's really hard to raise cash in the immediate couple years after you turn profitable because of the way companies are valued.
Well, and of course, anyone that wants an entrepreneurial culture is going to want one in which you don't reduce that original vision once a company starts posting a profit. So it's clearly a kind of an incentive problem in the way these things are funded.
That's right. And it's this crazy quirk where many companies have figured this out.
Yes.
And as a result, burn cash at all costs.
Never post a profit.
Never post a profit because then you're just valued on the dream and you're valued on revenue growth and earnings are irrelevant. So it's kind of this counterintuitive where, as a CEO, you're taught, go earn a profit, like turn your company profitable.
Right.
And in the markets today, you're not valued for that at all. You're only valued on growth and profits be damned.
Wow, that's something. Bryan, fascinating stuff. Good to see you.
Well, thank you, Jay. Thanks for having me.
This is Jay Richards, and we're at COSM 2021.